Whole life versus universal life. In this educational episode, I'm going to address what are the main differences between whole life insurance and universal life insurance. Get ready. You're going to gain insights into some things that you probably were not aware of before. So I'm Doug Andrew. I've been a financial strategist and retirement planning specialist now for nearly 5 decades, helping people optimize assets, minimize taxes, prepare for long-term goals like retirement so that they will not outlive their money. And one of my favorite financial instruments to accomplish goals like that is a max-funded indexed universal life insurance contract. And a lot of times people will say, well, Doug, have you checked out whole life? There's a lot of whole life agents out there that throw rocks at you, and they think it's a scam or whatever, and I just snicker and I go, oh, bless their little hearts, they just don't know what they don't know. So let me explain the basic differences, and then I have a challenge to issue to whole life agents. And I'm going to show you 4 major drawbacks that I see in whole life and why I have never owned one and I never will, okay? So simply put, all life insurance has a pure mortality cost to it. In another episode, I was talking about the 1958 mortality tables. They were changed in 1980, 2001, 2017. And it just shows that starting at age 30 and every 10 years, the actual deaths per 1,000 for a 30-year-old and then a 40-year-old and a 50-year-old go up. This is a no-brainer. But see, the cost per 1,000 of insurance would be $2 and then $3.50 and so forth, where pretty soon you're paying $228 a 1,000 when you're age 90. That's the pure mortality cost. Whole life, instead of having this premium go up every single year, whole life was designed to pay one level premium your whole life. And so you would look at the crossover point somewhere around age 60 or 65, let's say, and you would pay a premium between $20 and $30 into a whole life policy, let's say. And if you paid that, you were way overpaying the early years. That allowed you to underpay if you're still alive after age 65. It used to be back in 1958, 1/3 of males were dead by age 65. And so the other 2/3, if they still wanted life insurance protection, they could still pay the level premium because they had overpaid the early years. That overpayment into that permanent life insurance policy builds up cash value in the policy or equity. And something that a lot of agents don't understand is if the insurance company is charging you based upon the mortality charges that the CSO, Commissioner Standard Ordinary Tables, say they can charge, but they screen out people with medical exams and those who are more healthy, smokers versus non-smokers and what have you. So if they actually screen out a lot of those people that would potentially die in the mortality table, then they can be more profitable. And so they have usually excess money at the end of a year, and they refund that back, and they call it a dividend. Now, clear back in U.S. Treasury Decision 1783, it's explained that they're really not dividends in the commercial sense of the word. Otherwise, they'd be taxable. They're simply refunds of overcharge because they overcharged you and then they refunded it, but you can leave those dividends in there and it will grow with your cash value so that the policy can build up a cash value in case you live a long time and interest rates and performance goes down. The guarantees in whole life make sure that the death benefit will be paid out if you live to be, 100 years old, okay? But those guarantees, as attractive as they may be for death benefit, they're actually a detriment if you're wanting to use life insurance for living benefits, primarily for tax-free income. And you'll see what I'm going to talk about with the challenge to whole life agents, okay? And so whole life insurance, many times you could overpay for up to age 65, even more money, and maybe stop paying premiums. You even could pay for 20 years or 10 years. But see, in 1980, when universal life was introduced by E.F. Hutton, It wasn't term. It wasn't whole life. They were primarily wanting to use it for living benefits, the tax-free accumulation under Section 72E and the tax-free access under 7702. Because when you die under Section 101A, it's always going to transfer tax-free to your heirs. But the primary objective was to generate tax-free income. So when Universal Life came out, I actually had clients that put in $500,000 in one single premium back in the early 1980s into a max-funded Universal Life. And they were earning 11 to 15%, but they were netting within 1 percentage point, earning 11, netting 10. So they could withdraw $50,000 a year of tax-free income without depleting principal, or if they didn't need the income, that $500,000 at the actual net internal rates of return would double about every 7.5 years. $500,000 of cash value would be worth $1 million in 7.5 years, and then $2 million, and another 7.5, and then $4 million, then $8 million. At the end of 30 years, they have $8 million because Universal Life was designed to take the least amount of insurance, put in the most money, and the cash value grew to equal and then exceed the death benefit required under the Tefra tax citations. It equaled or exceeded the original required death benefit within 12 years, usually by the 17th or the 20th year. Their cash value equaled the death benefit, and then the cash value grew and the death benefit grew 5 percentage points ahead of it. They became self-insured. So this is my challenge that I want to propose to whole life agents, okay? And I know you're going to be hard-pressed to do this, but this is what I want you to do. Number one, I want you to illustrate a whole life insurance policy for a preferred rated male age 60, okay? That will accommodate $500,000 of total aggregate premiums that this client wants to put in as fast as they can put it in there to avoid a MEC, a modified endowment contract, because they want to access money tax-free. Does that make sense? So show it funding the $500,000 as fast as you can to get all $500,000 in there. Does that make sense? Number two. I want you to let the cash values as you're funding it, and after it's funded with $500,000 and you stop, I want you to accumulate those cash values to age 70 and then illustrate the maximum annual tax-free income that whole life policy can generate starting at age 70 for 50 years out to age 120 without the whole life policy lapsing. Illustrate the maximum amount of tax-free income. You got it? Now, third, I will let you use the actual typical interest and or dividends or variable results. I'll even let you use a variable whole life that was actually achieved each year beginning in 1995, meaning the male age 60 starts the policy in the year 1995, okay? And go all the way to the year 2020. So 25-year actual history. In fact, I want you to then use that average crediting rate for the rest of the policy up to the year 2055 when he's 120 years old. Or I want you to prove to me the actual performance of that whole life policy from 1995, let's say, to 2020. You can use that retroactively and just use that average rate of return or interest crediting rate for your illustration. Okay? Does that make sense? Because I'm going to do an apples to apples comparison, because here is the fourth step. This is going to be compared to an indexed universal life where the policy is funded during the same time period, 1995 to 2020, and then funded and generating income. Everything's going to be the same. And I'm going to use the caps that were typical for the given years, because in the decade 2000 to 2010, my clients capped out as high as 16, 17, 25%. That's what they actually did. And then when the market went down, they didn't earn anything those years. And I'm not going to rebalance, even though I usually tweak my rates of return from about 9 to over 11% by rebalancing every year based upon recessions and what have you. I'm going to handicap my illustration And I'm not going to rebalance during the recessions. I'm just going to sit there, but I'm going to allocate it in a diversified, simple diversified manner. Now, many times I diversify in at least 5 indexing strategies. We'll just link to a 1-year point-to-point with 40% of the cash values, a 2-year point-to-point with another 40% of the cash value, and the last 20% of the cash value will link to a 5-year point-to-point, and we'll just leave it that way, and we will take it out to age 70 and start taking out the maximum income so it won't lapse until age 120. And let's see what your whole life can do compared to what the IUL did or can do based on actual performance. You got it? Now, this is why I'm very confident. There are 4 major drawbacks. When people say, Doug, what are the major drawbacks about whole life? Okay, based upon what I just challenged there, to create a whole life policy for the primary purpose of using it for tax-free retirement income, which is why most people come to me is for living benefits. Whole life requires more death benefit than universal life. And so under those IRS guidelines, the whole life is naturally going to cost more because of guarantees, and you have to have more death benefits, so you have unnecessary costs. You don't have to have that much life insurance if you're going to use it for living benefits. So right off the bat, whole life is going to be more expensive. Number 2, under the TAMRA, that's the Technical and Miscellaneous Revenue Act tax citation, to avoid the insurance policy becoming a MEC, a modified endowment, which if you mess that up, it triggers tax when you start taking out income. We don't want to do that. The whole life policy will take longer to fund, usually maybe 7 years compared to universal life. I can get that $500,000 in there. I can get most of it in there in 4 years. I can get it in 3 years and 1 day. Whole life takes 6 years and 1 day, okay? And so that's another big reason. And the third big drawback, this is a little bit complicated, but I'll state it here. The guarantees that whole life touts are actually, they're actually a detriment to the policy performance when you're using it for living benefits. The best whole life policy that I've ever seen was an agent that created one with a very strong, reputable company, and they were assuming 8% dividends. And do you know that it took until age 95 before the internal rate of return on that whole life policy, we didn't take out any money, it took until age 95 before the internal rate of return on the cash value at age 95, retroactive back to day 1, equaled 5.9. So we'll just round it up to 6. What does that mean? That means 2 of the percentage points, 2 of those 8%, went out to costs on the whole life, and the net internal rate of return was only 6. You had to gross 8 to net 6. And that's the best whole life policy I've ever seen. If you would have started taking out income, it wouldn't have been that good. With universal life, okay, based on actual historical performance, I have been able to earn, without rebalancing, 9.62%. My money doubles every 7.5 years. At 9.6, if that was the gross rate of return, because I didn't rebalance, only 1 percentage point, retroactive back to day 1, is the actual cost of the insurance and fees and everything else that netted our clients 8.6, okay? So the point is this. Whole life, you have to earn 8 to net 6. Universal life, it will earn 9.6 and I can net 8.6. I can net out of universal life more than the gross that whole life has historically credited, okay? And that's why I challenge you to create one. So the fourth big drawback is this: because whole life was built on a chassis primarily with guarantees for a death benefit, it can't perform as well as a policy that was designed from the word go for living benefits, okay? It's very rigid. In whole life, certain premiums must be paid or the policy is going to lapse or it's going to be forced into non-forfeiture options. You don't have flexibility. Most of my clients, they want flexibility. I have a beatitude: blessed are the flexible, for they shall not be bent out of shape. People who own whole life, they get bent out of shape all the time because if they can't stop and coast. Do you know that universal life, I can design one to accommodate 500,000, like my challenge, and you can put $100,000 in, and you could coast for 10 years without adding another premium to it. before you would have to put some more money into that universal life policy. You can't do that with whole life. It's not flexible. So my challenge here is really, I want to cut through to the chase and make sure you understand why max-funded indexed universal life, when you put in the most money and take the least amount of insurance, the cash value will equal or exceed the death benefit, usually within 12 to 17 years. You're self-insured. There is no more cost of the insurance. And yet whole life agents say, oh, that's going to crash and burn. It's going to get too expensive. You need guarantees. Why do I need a guarantee on my life insurance that the death benefit will be there when my cash value equals the death benefit within 17 years? Why do I need guarantees of a death benefit when my cash equals the death benefit and then forces it to grow from that point forward? Is this making sense? So if you want to learn more, I would strongly recommend that you study this book. It's called The Laser Fund. This is a max-funded indexed universal life insurance contract, structured correctly and funded properly. So it's deemed what I call a laser fund, liquid asset safely earning returns. So you could go to Amazon and get this 300-page book for $20. And if you do, thank you, but I'll gift it to you free. Simply go to laserfund.com, click on the link below. You contribute a nominal amount toward the shipping and handling. I'll cover the rest of that cost. I'll pay for the book. I'll ship it out to you. And while you're in there claiming your free copy, check out the audio and video versions if you like to listen and learn or watch and learn. Check out the educational webinars we do on a regular basis. There's no charge for those. You can even schedule an appointment with an IUL specialist that I have trained that can create an illustration for you at no cost or obligation. But really, you need to compare it the correct way. And that's what I feel bad about is so many whole life agents, they simply don't know what they don't know. And they maybe came that way honestly because their supervisor never shot straight with them or understood universal life in the first place.